Welcome back to the Daily Crypto Roundup. What a week it's been across the crypto markets. Sharp sell-offs, violent rebounds, sentiment swinging from extreme fear to cautious optimism in a matter of days, and a lot of retail traders asking the same question right now. Was that the bottom? Or is this just another trap before lower prices? Over the last few sessions, we've seen billions wiped off total market cap, major altcoins take double-digit hits, XRP having the highest losses at one point, and Bitcoin briefly lose, then aggressively reclaim key psychological levels. Analysts are split. Some are calling this a classic capitulation phase. Others say this is exactly what a late cycle shakeout looks like before the next leg higher. Today we're going to walk through what actually happened, what analysts are saying right now, and how experienced investors are positioning themselves through this volatility. Before we get into the stories, a quick reminder to follow the show if you get value from these daily updates. It really does help the podcast grow, and it keeps you plugged into what's happening in crypto without the noise. Now let's start with the market snapshot. Bitcoin is trading around the $70,000 region again, after briefly dipping below it earlier this week. Ethereum is still struggling to regain momentum, sitting well below its recent highs. XRP has been one of the most volatile major assets, suffering a sharp drop before stabilizing. Solana, Cardano, and Dogecoin have all seen heavy selling pressure, with some relief bounces but no clear trend confirmation yet. As always, these coin prices are sponsored by Ledger. If you're holding crypto for the long term, self-custody matters, especially during volatile periods like this. If you want to secure your assets properly, you'll find the Ledger wallet link in the description. Now let's get into the actual stories driving this market. The first and biggest headline this week has been the sheer scale of the sell-off across altcoins. At one point, XRP was down over 20% in a matter of days, leading losses across the top 10. Liquidations spiked. Fear indicators dropped to levels we haven't seen since previous major corrections. Nick Puckrin, investment analyst and co-founder of Coin Bureau, summed up the mood bluntly, saying that when markets move this fast and this violently, it's usually a sign of capitulation rather than a healthy pullback. He pointed out that real bottoms tend to form slowly, not in a single V-shaped bounce, and warned traders not to confuse short-term relief rallies with confirmed reversals. At the same time, other analysts are starting to push back on the doom narrative. Several desks, including analysts at Galaxy Research and Bitwise, have noted that Bitcoin reclaiming the $70,000 level so quickly after losing it is not something you typically see in the early stages of a bear market. Their view is that while volatility is likely to remain high, the market may now be entering a grinding consolidation phase rather than a full breakdown. This idea of grinding out a bottom keeps coming up. Instead of a dramatic crash followed by an instant moonshot, analysts are increasingly expecting sideways action, false breakdowns, and choppy price behavior designed to exhaust both bulls and bears. That brings us to Bitcoin itself. Bitcoin briefly lost the $70,000 handle earlier this week, triggering panic among newer investors who had been conditioned to see that level as unbreakable. But within days, Bitcoin reclaimed it, forcing short sellers to cover and adding fuel to the rebound. Avinash Shekhar, CEO of Pi42, commented that this kind of price action reflects a market still dominated by larger players rather than retail. According to him, smart money tends to use sharp drops to build positions gradually, not chase green candles after rebounds. He stressed that staggered accumulation near key support zones remains the preferred strategy for long-term investors, rather than reacting emotionally to headlines. And that's an important point. While social media has been filled with panic, experienced investors have largely been doing the opposite. One of the more talked about examples this week was entrepreneur Patrick Bet-David publicly confirming that he had accumulated more Bitcoin and XRP during the sell-off. Whether you agree with his views or not, the pattern is familiar. When markets are bleeding, long-term conviction players tend to step in quietly, while short-term traders are forced out. On XRP specifically, analysts remain deeply divided. Some see the recent drop as a warning sign that speculative excess is being flushed out. Others see it as one of the more compelling risk-reward setups in the market right now. Scott Melker, known to many as the Wolf of All Streets, described XRP's recent price action as a high-conviction technical setup, provided key support levels hold. His view is that when assets are heavily punished despite no major change in fundamentals, the bounce potential can be significant if sentiment shifts even slightly. That said, he also cautioned that XRP remains one of the most emotionally traded assets in crypto, making it prone to exaggerated moves in both directions. Zooming out, a lot of analysts are tying this entire move to sentiment rather than fundamentals. The Crypto Fear and Greed Index dropped into extreme fear territory during the worst of the sell-off. Historically, those levels have often coincided with medium-term buying opportunities, but not necessarily immediate bottoms. Several analysts have pointed out that fear can stay elevated for longer than people expect. Just because sentiment is bad doesn't mean price has to reverse straight away. This brings us to the broader macro narrative that's been floating around this week. Some commentators, particularly in traditional finance media, have started reviving the phrase crypto winter. Headlines from outlets like the Wall Street Journal have suggested that even some longtime crypto bulls are unsure what exactly triggered this downturn. But many crypto-native analysts are pushing back on that framing. Their argument is simple. Crypto winters don't usually start with Bitcoin holding near all-time highs, institutional ETF flows still active, and long-term holders refusing to sell. What we're seeing instead looks more like a violent mid-cycle reset, and that distinction matters. If this were the start of a prolonged bear market, you'd expect to see sustained breakdowns, declining on-chain activity, and a loss of institutional interest. So far, that hasn't happened. In fact, ETF-related activity continues to play a major role in Bitcoin's price behavior. While flows have been choppy, there hasn't been the kind of mass exit that would signal a structural shift away from Bitcoin exposure. Another important point analysts are making is about retail behavior. Bloomberg published a piece this week highlighting how many retail traders were caught offside after the so-called Trump-fueled crypto rally faded. The key takeaway wasn't political, but psychological. Retail tends to enter late, chase narratives, and panic at the worst possible moments. Experienced traders know this pattern well. The market's job is to make the maximum number of people uncomfortable. That's exactly what this week has felt like. Now, before we move on, a quick word from today's sponsor. This episode is sponsored by Kraken. Kraken is one of the longest-standing and most trusted crypto exchanges in the industry, offering spot trading, futures, and staking across a wide range of assets. If you're looking for a reliable platform to trade or accumulate crypto during volatile conditions, you'll find the Kraken link in the description. Now let's get back to the analysis. One of the most under-discussed aspects of this correction has been leverage. Data from derivatives markets shows that a significant amount of leverage was flushed out during the sell-off. Long positions were liquidated rapidly, particularly on altcoins, which helps explain why moves felt so exaggerated. Analysts often view this kind of leverage reset as healthy, even if it's painful in the moment. Excess leverage amplifies instability. Once it's removed, markets tend to behave more rationally. That doesn't mean price goes straight up. It means moves become less chaotic. Another theme emerging from analyst commentary is time. Several veteran investors have stressed that the biggest mistake retail makes is expecting instant gratification. Markets don't reward impatience. They reward positioning. As one portfolio manager put it this week, wealth in crypto has historically been built by those willing to look wrong for extended periods before being proven right. That idea ties directly into how you approach moments like this. If you're over-leveraged, chasing short-term trades, or relying on exact timing, periods like this can be devastating. If you're investing gradually, managing risk, and thinking in years rather than weeks, volatility becomes an opportunity rather than a threat. Looking ahead, analysts are watching a few key things. For Bitcoin, the $70,000 level remains crucial. Holding above it would strengthen the case for consolidation rather than continuation lower. Losing it again wouldn't necessarily be catastrophic, but it would extend uncertainty. For Ethereum, analysts want to see signs of relative strength returning. Right now, Ethereum has lagged, which historically can either signal weakness or set the stage for rotation later. For XRP and other high beta assets, volatility is likely to remain elevated. That cuts both ways. Big drawdowns often precede big moves, but timing remains difficult. One analyst summed it up well by saying that the next few weeks are unlikely to reward traders looking for clean trends. Instead, they'll reward patience, discipline, and risk management. Before we wrap up, it's worth addressing the emotional side of all this. Markets like this are exhausting. They test conviction. They make you question your thesis. They tempt you to overreact. But every major cycle in crypto has included moments like this: sharp corrections, doubt, headlines declaring the end, and then, eventually, continuation. That doesn't mean prices are guaranteed to go higher from here. Nothing is guaranteed. But history suggests that the worst decisions are often made when emotions are highest. So whether you're bullish, bearish, or undecided, the most important thing right now is clarity. Know your time horizon, know your risk, and don't let noise dictate your strategy. That's it for today's Daily Crypto Roundup. If you found this useful, make sure you're following the show, and if you want to support the podcast while securing your crypto, you'll find the Ledger and Kraken links in the description. Drop your thoughts in the comments, smash like, follow, and as always, we will see you at the top.